Coming up on the SBS on the Money podcast, our special interview with Australia Post CEO Paul Graham, and we wrap up reporting season with Virgin Australia and Harvey Norman. All of that and more next. Everyone, welcome to the SBS on the Money podcast for this Friday, the 29th of August 2025. It's a day where the Australian share market fell slightly. The S&P ASX 200 down 0.1% to 8,973. I'll have the details with Dianne Colledge from Morgans in a few moments, including her analysis of the profit reporting season that was. But first to Australia Post. The company is already lifting stamp prices and delivering mail on fewer days, and has warned its post office network will change, especially in metropolitan areas where there is significant overlap. That's as a structural shift continues in the industry, which saw it post a modest pre-tax full-year profit of almost $19 million, up from a loss in the previous year. And most of its $9.5 billion record revenue came from its parcels business, which continues to grow, although it faces intense competition from global e-commerce platforms. And Letters made another loss, this time of $230 million, and the service doesn't expect to ever return to profit. But what of the future of its post offices? For that and more, I spoke with Australia Post CEO Paul Graham. Paul, so postal operators in the US, Canada, France, Spain and the UK have required billion-dollar government-funded bailouts given the structural changes in the industry, while Australia has avoided it. Is it inevitable though? Because as you say in your release today, while you've turned a profit this year, future profitability is likely to be temporary.
Yeah, look, we have seen that play out in other postal operators. I think the difference with us is that we have a clear plan for the future. We've been able to take stakeholders with us on the journey, be that our union partners, government, our communities, and so far we're executing that plan well. But we don't believe that we will get in a position to take government funding, and that's what we're trying to avoid, but it will need the support of multiple stakeholders to allow us to execute our plan to achieve that.
What kind of support?
Well, we continue to work with government, obviously, and the ACCC in relation to the price of a stamp. That's one lever that we can pull to minimise our losses in relation to our letter business. Obviously, we were able to implement with the government support a new delivery model that sees us now delivering every second day. As mail continues to decline, it declined 11.7% last year. We'll need to continue to work on what that new delivery model looks like going forward. We're seeing mail volumes now that we haven't seen since the 1930s. And then our post office network, essential role that we play, particularly in regional and rural towns, but in metropolitan areas, we know that there is significant overlap. So we'll continue to work, say, with communities, with other stakeholders, on continuing to fine-tune our business to reflect the needs that customers have today and in the future, and to use our strong brand position and the great services and products that we offer today to try and ensure that we provide to Australian retailers the best alternative to the global platform players, which are in Australia and growing very aggressively.
You've got more than 4,000 Australia Post offices, but foot traffic continues to decline. Over-the-counter transactions are falling. Most of your businesses in these shops are parcel related. What is the future for these services, and is the reality that the public needs to accept there'll be fewer of them, or at the very least they'll look very different in the future?
They will look different, and we're already doing that. So we've rolled out new formats. We've got our new parcel at post format. We've got 3 of those on the ground. This is a post office dedicated just to parcels. 62% of all our visits in a post office are parcel related and continuing to grow. We still have 17 million people visit our post offices every month. So whilst that traffic is declining, it's still substantial. And we recognise the balancing act we have to ensure that we stay relevant and provide the services that different communities need. So what a community in a regional town needs for banking and other services is very different from what a community in a high, dense, built-up area in metropolitan areas need. So we're trying to make sure that our formats reflect the needs of those customers. So you'll see us increase significantly the rollout of our parcel lockers, because that is a significant service benefit to our customers who want the 24/7 access and the convenience of being able to manage that through their mobile phone. We have currently a regulatory number of 4,000, 2,500 of those in regional and rural Australia, and that's the current number that we will work towards. But we will continue to look at our network and its relevance, frankly, to the needs of our customers. Whatever we do in that network is not because we've sat in the room and thought it's a good idea. It's based on the feedback we get from those communities and the services they want today and into the future. And increasingly, that's more and more about parcels.
So without simplifying it though, does it mean more lockers, fewer post offices?
It's a combination of many things that relate to that particular community. So for example, we've recently dealt with one community where there's an original request for a post office. As we understood their needs, younger families, both parents working, time constrained, what they really wanted was parcel lockers. And as we've put those on the ground and other self-service options, that community is incredibly satisfied because that meets their particular needs. In other communities, those needs are different. We recently opened a brand new post office at Oran Park in Sydney's West, a fast-growing residential area where we felt, working with that community, that the best solution was actually a full-service post office. So it varies by community.
As you mentioned, your parcels business is a standout. It forms 80% of total revenue, but competition is rising from global e-commerce platforms and multinational delivery companies. Run me through just how intense competition is and what it means for your business.
That competition is very, very intense. I would say it's one of the most intense segments of any business in Australia at the moment. We have seen the growth of the platform players. We estimate they will control over 50% of the e-commerce market by the early 2030s. That's a real challenge to the Australian retailer, both bricks and mortar and online. Our goal is to make sure that we are the best alternative to the platform players for the Australian retailers so that they can compete. And we do that by providing competitive prices, great service experience, and continue to invest substantially in our network. We've spent $1.5 billion over recent years in expanding capacity, in new digital technology, and also in delivering new services such as our next day metro service, where a product can pick today in a metropolitan city around Australia, and we will deliver that product the following day.
What about AI? How are you using it, both customer facing and in your operations?
We are using AI. We're no different to any other large organization. We are continuing to develop how we apply that in our business. It has uses in our call center, for example. We're using that in our back office in terms of analytics. So we are no different to any other company. We are looking at how we can apply that to drive efficiency in our business, to also improve the productivity of our team, and also to enrich the job experience that they have. So our overriding philosophy is AI for good, but we are still in the embryonic stages of how we embrace that and what that means to our business.
You've recently temporarily suspended parcel shipments to the US following tariff rules on low-value products. Where are you on working on a solution?
We are working night and day, and the team is probably sick of me asking when are we going to be able to deliver it. But we are working night and day with Zonos, which is one of the approved platforms that the US government has approved for the calculation and collection of duties and taxes. I would say we will be implementing that platform in weeks, not months, but every day we are working hard to do that. And what that will do is provide a long-term solution to Australian exporters who will have duties and taxes calculated for them automatically, and the recovery of those on behalf of the US government.
What role does diversity and inclusion play at Australia Post?
Look, it plays an incredibly important role. We believe that we are one of the most culturally diverse organisations in Australia. We touch every single community every single day. We've got 139 different ethnic groups that are recognised in Australia Post. Today is Wear It Purple Day. I'm wearing our Post Pride badge in recognition of that. As we've seen across the world where other jurisdictions have pulled back on DEI, we are actually continuing to invest and make sure we talk about that, whether that be people with a disability. 6.5% of our workforce are people with a disability. 3.5% First Nations, and a very large LGBTQI plus community. We celebrate that diversity, we celebrate that inclusion, we make it part of everything that we do in relation to our underlying culture, and what we develop is an environment, hopefully, where people come to Australia Post knowing they are welcome as their true selves, and that they can work here and progress here in an environment that's psychologically safe and celebrates the great diversity that we have both in this country and in the great business called Australia Post.
Just one quick follow-up. You mentioned that you're doing DEI at a time when a lot of the rest of the world is pulling back. Why?
Because we believe it's the right thing to do, and we believe that's what our people want. Our people feel great about working Australia Post because we are so community-based, because we welcome that diversity, because no matter who you are welcome here, you can make a contribution, and we will judge you on the contribution you make, not because of your background culturally or anything else. And I think that's one of the core strengths of the culture that we have, and it's important to our people, and if it's important to our people, and it's important to us.
That's Australia Post CEO Paul Graham there. Let's take a look at the Australian share market now, which fell on the final day of reporting season. The S&P ASX 200 down 0.1% to 8,973. If we take a look at the best performing sectors, 6 of the 11 sectors were lower today. The worst performing sector, property. The best, though, information technology. And that's because of a 17.4% rise in shares of NextDC, the data centre. Austal also doing well, up by 15%. The worst performers included PEXA Group, down by 9%, and Mesoblast, off by 9.9%. For more on the day's market action, including profit results from Virgin Australia and Harvey Norman, I spoke with Dianne Colledge from Dianne, Morgans. Finally, reporting season is virtually over. What's your overall analysis been like, and what do you see as the main themes?
Great question, Ricardo, and I can't tell you how thankful I am that it is nearly over. We have seen one of the highest levels of volatility around reports from companies that has happened in a very long period of time. So just to give you a bit of an outline, in only 17 occasions in the last decade, we've seen ASX top 50 stocks belted 10% or more on delivering their results to the market. Some of the other themes that we've picked up is that the actual wins or better results than expected have been a lot less than the lower results where they've come out with negative news. We've also seen where the market seems to be very fixated on very short-term results post the June 30 cutoff. So the first 6 to 8 weeks of trading for some of the companies have been a priority for what the market's been looking at. And a prime example of that is where we've seen Coles and Woolworths as a comparative, where Woolworths came out with a very sort of lackluster trading update for the first 8 weeks, and they fell 15%, where you saw Coles that was a lot more positive and had a stronger result for that period of time was up 15%. So, you've just seen that contrast between how the companies have delivered that piece of news to the market and how they've been treated.
We still had a few laggards today, so there were still some numbers which I'd like to go through if we can. Virgin Australia, following Qantas's second best profit result yesterday ever. Virgin profit up 28%, its first result since returning to the ASX. What did you make of it?
Well, it was really interesting. As you say, it did follow on Qantas, and Qantas was an excellent result, particularly in that Jetstar segment of the market, and I'm sure you focused on that yesterday. So when you think about a comparative again, Virgin had an 8.5% increase in revenue, and that created $5.8 billion, which is quite exceptional for a company that was, as you say, newly listed to the ASX. They have also looked to increase capacity, particularly in the domestic market, and that's on the back of the consumer wanting that discounted holiday and travel experience. So they've seen their margins expand to around 9.6% or 535 million, compared to Qantas, again, where the key airline there, 14% up on their margins, and Jetstar was even better at 16%. But Virgin themselves has definitely delivered. They haven't put out a dividend, initiated a dividend at this point in time. And again, that's sort of comparative to Qantas that put out a special dividend. So again, it's just really quite interesting.
One of the star performers on the market today is Harvey Norman. 39% rise in full year profit before tax, rising revenue, resulting in a higher dividend. What do you make of the result? And is there anything in those numbers or in the commentary about how the consumer is feeling?
Absolutely. So I think if you go back to the start of the reporting season, you would have seen Nick Scali come out with a very solid result as well. And again, we're sort of seeing a bit of thematic around more domesticated revenues being a lot more rewarded. So anyone that has more of a domestic business has outperformed anyone with an international focus by around 8%. So when you look at that, I mean, even though Harvey Norman surprisingly has they're building a showroom in Croatia, which I had no idea about. But when we revert back to the results today, they had very strong operating cash flow of 694 million. They had a cash conversion rate of 95%, which is very attractive. They've got total sales of 9.35 billion, great dividend to shareholders, and they had again a really solid trading update for those first 6 to 8 weeks of 9.9%. So when I revert back to what I said before, anything that has shown that the consumer is actually spending money is being rewarded by the market. And I think if you revert back to the retail sales numbers, and particularly there was a slide in the CBA result that showed that we are spending more money and we are saving more money at the same time. So the Australian consumer and the economy is actually doing quite well.
Yeah, Matt Common made sure he told us about that too when we spoke to him on the podcast. Any other results catch your eye today?
Yes, so we've had a really solid result and update from NextDC, which is a data center provider that's obviously building off all the AI generative technology and cloud services and the hyperscalers. So they came up with a very strong result. They're going to have excess capex of about 1.9 billion, but they're also expanding into KL and building in Tokyo as well, which is quite interesting. But they've got a very strong balance sheet. They've got total assets of around 5.7 billion. It's one of our key picks in that technology data center space. And we think that it will do quite well. And the market actually does applaud it as well. So it's up about 17% today.
Okay, and just wrapping up, what are you telling your clients right now and where do you see the opportunities for them?
Wow, interesting you say that as well. Interesting to see that Sigma, I'm not sure if you've seen that, has had since its result, which was quite a good result, obviously now embedded into the Chemist Warehouse operations and their store rollout and expansion, has had quite a number of their founders sell down quite large amounts of stock. So there was nearly $500 million worth of stock sold yesterday and today through institutions. And that to me looks like a really good opportunity to get into the Bunnings of chemists, if you like. And it's a new entrant to the market, and it obviously does provide us with an opportunity to get a growth company that's not overvalued, because ultimately our market's quite high on a relative PE basis at the minute. So to be able to buy that does look like a really good opportunity. The second thing I'm telling clients is to actually just wait until the dust settles after the reporting season, have a look at what the analysts come out to say, where there is true value to be found, and also to collect those dividends that are out there at the moment.
That's Dianne Colledge there from Morgan. It wraps up the podcast for today and for the week. Don't forget, if you do enjoy it, to give it a rating or review on Apple Podcasts and Spotify. And
this SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.